In this video, I'm going to highlight how SoFi accounts for the value of loans on its portfolio, and I'm also going to discuss why its choice is good news for SoFi stock investors. So let's begin. So SoFi is one of the few banks that uses fair value accounting. Remember that term, fair value accounting. So CEO of SoFi discusses why they chose that. So we have two choices when we originate a loan. We can either elect fair value or at cost accounting. There's a bunch of reasons for that, but I will tell you, I think it's the best way to account for a balance sheet company that's using loans because these loans have to be mark to market. Okay, let me take a minute talking about mark to market, what that means. So, mark to market means every quarterly update that SoFi gives its investors, SoFi has to update the value of the loans on its balance sheet. It has to market to the market value, if that makes sense, right? Mark to market value. So every quarter, SoFi stock investors get an update, a real time update of what that portfolio is worth. Because during a quarter, many events transpire that changes the value of those loans on the portfolio, right? One of the main things that changes the value of a loan is interest rates. When the Federal Reserve raises interest rates, that decreases the value of loans. Interest rates move higher, value of loans moves lower. They have an inverse relationship. You can think of why that's the case. I typically use this example when I'm teaching my students at university about why rising interest rates decreases the value of loans. If interest rates go up and your bank is giving you a savings rate of 2% or 3% or 4%, whatever it might be now, but you have a loan whose value was 3% and now your bank is giving you more than what the loan is worth, you're obviously not going to want to invest in that loan because you'd rather put your money in the bank account at a higher interest rate with lower risk. So the value of that loan needs to decrease in order to get investors to purchase that loan. So the market value of the loan decreases because the attractiveness of the loan decreases. If you can get a higher interest rate elsewhere, then why would you want this loan at a lower, that's paying you a lower interest rate? Right? As an investor, you want higher rates, right? You want a higher rate of return. And if this loan was made 6 months ago at a lower rate of return and the new loans, the new market rate is much higher, of course, these loans that were made earlier have to decrease in value. They have to decrease in value. The market value decreases. So in fair value accounting, you can choose to hold for sale or hold for investment. Under that accounting, under fair value, we mark to market our loans each quarter. And I discussed one of the factors, but every factor that could change its value, we have to recognize it real time, and it flows through our income statement and our balance sheet. So I just mentioned one of the factors that changes the value of a loan. I talked about interest rates. But SoFi needs to consider more than just interest rates on the value of those loans. Another factor could be the unemployment rate of the economy. If you have a portfolio of loans that were made when the unemployment rate in the economy was 3%, fast forward to today and the unemployment rate has increased to 8%, now the value of those loans have decreased. Why? Because more people have lost their jobs, and if more people have lost their jobs, that means more people are going to default on those loans that were made a year ago or 6 months ago or whenever they were previous to the higher unemployment rate in the economy. So during the passage of time, during a quarter, many events happen that change the value of a loan. It doesn't have to change the value of the loan downward. It could change the value of the loan upward. If interest rates decrease, for example, that would increase the value of your portfolio upward because now you've got a portfolio of loans that's paying 4% when the market rate is 2%. So obviously investors would rather have the 4% loans because that's a higher rate of return. And so the value of those loans increase, right? So every quarter as time passes, those loan values change based on the different factors that change over time. So why is that good news for SoFi stock investors? The fact that SoFi chose this method and is one of only a few banks that uses this method of accounting. And the main reason is transparency. Transparency. Always, 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 the more transparency is more beneficial for investors because you get to see what's going on under the hood. And if you can see what's going on under the hood of these banks, you can make a more informed decision. And a more informed decision is a less risky decision. And less risk always means that you are willing to pay a higher price with lower risk, right? So there you have it. That's why this decision for how SoFi accounts for its loans is good news for SoFi stock investors. Thank you so much for watching. I hope I'll see you again. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.